everyone, good evening. My name is Riddhi Behel, and welcome to our event for today, uh, Save, Invest and Manage Money by Mr. Nimish Mayani. Mr. Nimish has more than 28 years of experience in the finance sector, and he guides and trains corporates and their employees on how to achieve financial well-being, what is the power of starting early in terms of investment, what are the different kinds of aspects of financial planning, some of the myths that are there. He'll solve that for us. He'll also tell us on what are the types of investments that we should do where that would give us maximum returns. So he'll explain to us about some financial products as well. So welcome everyone to today's event. I'm very excited to learn how I can, achieve that financial well-being so as to in future, all of us have the financial freedom that we deserve. Welcome to all of you and welcome Mr. Nimish. Thank you so much for attending and doing this webinar and event for us. Before I pass it on to you, I would just like to say that any questions that you'll have during the presentation, please put them in the Q&A box, and or you can put them in the chat box as well. And Mr. Nimish will take up all of the questions at the end of the session. So over to you, sir.
Uh, Hi Riddhi, thanks so much for your kind words. Okay, so just to give a brief introduction of myself, I'm a AMFI registered mutual fund distributor, and we do distribution of financial products. Uh, and I'm associated with two large national distributors from wherein we, give guidance on the products which are required by the clients.
Okay.
Okay, yeah. As you already know, my background is from the banking sector and the capital market, with two of the best, you can say, the bankers and the broking industry, which is HDFC Bank and Edelweiss Securities. So, thank you all for choosing to spend your time this evening for this webinar. I will just proceed now to take the things ahead. So, as we know, today's topic is for introduction to your personal finance, investment, and tax avenues, how to save and manage money. So, we'll take it ahead.
Sorry, sir. I just want to point out here.
Yeah.
Somebody has mentioned in the chat that the voice is very low.
Okay.
Can you hold the
Yeah.
mic closer?
Sure. Now you
Yeah,
can.
much better. Much
Is it
better.
better now? Okay.
Yes, much
Thank you.
better. Thanks.
Thanks. Okay. So we'll take it ahead. So what is financial well-being? Today, when we talk, about financial well-being, it is that state of being where, the person is making the most efficient use of the financial resources available with him. That person is in a position to manage, any untoward or unexpected financial event, and he's on track to meet his current and future financial goals, which he has, kept in mind for his family, and he has a feeling about, some sort of peace and satisfaction about how the financial life is going about. Now, the way to manage this maze of how to achieve this financial goal, we go by following the five basic principles. The principle number one is identify where you are, where you want to go, and why. Today, when you go to work or if you're planning a holiday, you always identify where you want to go, how much time it will take. So that is how you plan the journey. The same way it goes for your financial planning as well. Now, what is the financial map when we say? So we ask people that, what is it, and at what stage do you require how much money? What is the purpose? Maybe it's your children's education, or for your marriage, or for a foreign trip abroad, or for renovation of your house. And when do you want it? So once we discuss these goals, then we get an idea as to what are your needs, what are your requirements, and accordingly we plan them. Now, coming to the principle number two, which says start early. Today, when you plan your journey, you always tend to leave early so that you do not have to rush in. Okay, so say if you're planning a trip from here to Lonavala, you typically know that on a holiday where everybody is going to be out on a long weekend, the earlier you start, you do not meet traffic. The same holds true even for financial planning. Now, we take a case study where Atul and Suresh were two friends, age 25, and they decided to save 10,000 rupees a month for their future provisioning and their goals. So that is 10,000 a month, which is 1 lakh 20 per annum. Okay, Atul says that I will start today and I will do it only for the next 10 years till my age of 35. So 1 lakh 20 into 10 years is 12 lakhs. Suresh's friend says, no, it's too early. Why should I plan for retirement today at my age of 35? I will do the same amount, but I will start at age 35 and I will go on for the next 25 years till age 60. So thereby his 1 lakh 20 per annum into next 25 years is 30 lakhs. Now at age 60, who gets a higher maturity at 10%? If you compound that figure, uh, I just want to ask, today we obviously we can't show a show of hands out here in the webinar, but if one were to decide, okay, Atul or Suresh, in the webinars or the physical meets which we've conducted, people generally feel that the person who has saved the most, he gets maximum returns. But here it is the other way around. It's Atul, the first guy, because the power of compounding has helped him. Now let's go on the numbers. Uh, just to clarify, 12 lakhs was saved by Atul. Okay, so his money has multiplied almost 18 times. So his corpus has become 2.18 crores at the age of 62 crores 18 lakhs. Whereby Suresh, who started 10 years late, his 30 lakhs has only grown to 1 crore 24 lakhs, which is only 4 times. So you can imagine, if you want your money to multiply, you need to start early. And like Mr. Albert Einstein has said, compound interest is the eighth wonder of the world. He who understands it earns it. He who doesn't pays it. Coming to principle number 3, allocate correctly. So what do we mean by allocation? When we talk about investments and all, it all gets invested into asset classes, be it gold, property, uh, uh, mutual funds, or equity investments, or even commodities for that matter. So asset is something which has potential to convert into cash. How fast you can convert into cash is the main goal of any asset class. Now they generally have three dimensions, liquidity, safety, and returns. But today, if you actually go to see, in any asset class, you will find two of the parameters, but the third one is always a little sticky. As we proceed in the slide, we'll see how it affects us. Principle number 4 is to stay focused. Today, you hear a lot of noise in the market. Market is going up, stock market is going up, or interest rates are rising. The idea of staying focused and trying to achieve your goals, the uh, the formula which people generally adopt and which we tend to do as common man is, when your income comes from that, you spend everything, and whatever is remaining, you save it. Okay, that's the formula which people adopt, but the correct way of doing it is income minus savings equal to expenses. So today, if you see, what Mr. Warren Buffett says, that don't save what is left after spending. You must spend only what is left after saving. That's the correct way of going ahead. So let me put it this way, that are you a spender or saver or an investor? The three classes are there in front of you. You must identify in which category you fall in. Today, if you are in the first category, then you need to understand that you need to to make money, you'll have to come to the investor category. And generally, people always tend to feel that what I'm putting money in the bank is saving, but there's a very thin line between savings and investing. Savings is putting your money to rest in the bank, but investing is making your money grow. So even when you're sleeping at night, if your money is not growing, then there is a problem. Just give me a minute. Just give me a minute, please. Riddhi, just give me a minute. Sorry for the interruption.
No problem, no problem. Just give us 2 minutes, everyone, please. We're just trying to figure out why the PPT has stuck and it's not moving ahead. Thank you.
Extremely sorry for the technical glitch. So coming to the next slide, these are some quotes by Mr. Warren Buffett. Okay, when we spoke about income and expenses, these are some quotes given by him. You know, so I'll just give you 2 minutes to just go through them. He says that on earnings never depend on single income. Make investment to create a second source. Then on spending, he says if you buy things you do not need today, soon you'll have to sell the things you need. So ideally, it all talks about what are your requirements, what are your needs. So if you don't, spend on what is required, soon you'll have to sell some things which you don't require. Then he talks about savings, on taking risk, and on investment, which we all know that we should say that do not put all your eggs in one basket. Okay, principle number 5 is hope for the best, prepare for the worst. So what do we mean by that? The idea is to build an emergency fund, which is minimum 3 to 6 months expenses in bank FDs, which are easily accessible. Then you must have adequate life insurance, health and disability cover, permanent disability. your critical illness, death, hospitalization, or retirement, joblessness. The idea is to, tell families to prepare for these sort of emergencies, so that in case, God forbid, any untoward incident happens, your whole, mind is not diverted to that one activity, but you are able to at least tide over the crisis if you have these sort of insurance covers. Prepare for the worst, like how we have, fifth car in the tire, or why do nations have a defense budget? Why do we even use uninterrupted power supply, or we have antivirus or shock absorbers? These are basically to prepare ourselves for the worst possible scenario. So just to recap, what are the five basic principles of financial planning? The first one, like I said, identify where you are, where you want to go and why. Start early, allocate correctly, stay focused, and hope for the best and prepare for the worst. Now, coming to the important aspects of financial planning. Today, there are a lot of avenues, land, gold, government bonds, securities, equity markets. You have mutual funds, you have bank fixed deposits, and even insurance covers. But everybody is in a confusion or a maze as to which asset class they should buy and how much they should allocate. What we tell people is, and make them understand, is that you must understand what are your pre-tax and post-tax returns, because tax can take away a sizable portion of your returns in the investments. So it's always best to look at the investments from the tax saving efficiency. Now today you have the two safest class, say PPF and bank FD as a comparison. Today PPF interest rate is 7.110, which is changing every quarter, as it was not changed for the last 2.5 years, but recently the government has made a change. So the interest rate is 7.10. There is no tax on your interest. So the post-tax returns are 7.10. Compared to that, the bank FD rate today is at 6.75. And if somebody is in the 30% tax bracket, the net returns in hand is 4.73. So ideally, we always tell people that you must never go by what is the gross rate. See what is the taxation part, and then understand what is coming net in your hands. Then there is another asset class, which is gold. If you see the gold prices over the last 36-40 years, it has risen very sharply after 2009, and then again in 2018-19 onwards. But if you see the gold prices between, say, 1980 to 2005, it has always been constant. So you must understand that if you're going to invest in this asset class, are you willing to hold out for that period of 10, 15, 20 years where there is no returns? So try and understand, which is the asset class and how much time you're able to spend in that class. Now, this is the history of gold for the last 95 years. Where if you see the amount of returns is has come over the last 8-10 years. Before that, it was very low if you compare. But today, gold has been, it has a lot of emotional value in families. Generally, the parents, grandparents and parents have always advised us that you must save the gold and keep it for a rainy day. But there is a new way of investing in gold rather than keeping physical gold now. So by that I mean the new way is which is the sovereign gold bonds, which has been introduced by the government of India. These are gold bonds which have been issued by government of India, which is managed by the RBI, and they are held in electronic forms. The government also gives you 2.5% interest per annum, which is payable half yearly. Okay, so here you have a different different way of holding the gold in electronic form, and the asset also appreciates. There's absolutely pure safety in this because it's issued by the government. It's tradable on the stock exchanges. There is a lock-in period of 8 years, but the government gives you an option that after 5 years, if you want to trade it on the stock exchange, you can trade it. The best part about it is there is no capital gains on redemption. So if you hold these bonds for 8 years, the capital gain is totally exempt. So here this is a brief table which shows you that when the series started in 2019, this was the price of gold, where I'm circling in the third column under the issue price per gram. Okay, and the last column shows the number of units which were purchased by the investors. Now, if typically if you tend to see during COVID period, during April, May 2020, that is the time, the everybody started in a rush to go and buy gold. So you must understand that when there typically there is a rush, why are people going there to buy that asset class? You must try to evaluate that is it the right sort of asset which is going to suit your requirements. uh, this is the last 6 months tables, where again the last issue had come out in June about these sovereign gold bonds. Now we come to this Residex. There are many people who invest in real estate. So generally the the way of finding out prices of the real estate was generally you rely on your local broker to find out what are the rates going on in the locality. But since 2007, the government has come out with what is called as a Residex. Like the Bombay Stock Exchange Sensex is there, you have what is called as the real estate Residex. So earlier there were only 26 cities covered initially. Now there are over 50 cities which have been covered by the system, and the base price of the index from 2007 has shifted to 2017-18. So you can do a Google search on NHB website, and you can try to evaluate what are the prices going on in your locality or city or neighborhood to evaluate the prices. Coming to equities, people always say that this is a very volatile class, equities. But if you tend to observe, equities are not risky in the long term. If you observe, anybody who stayed in the stock market for 1 year, and if he's done direct buying and selling of shares, if you look at the bottom of the screen, there is a probability of loss and the loss percentage which is given. So anybody who stayed in the market for 1 year, out of 43 times, there is a probability that 14 times he's made a loss. Coming to the 3-year holding period, where somebody who stayed in the market for 3 years, his probability of loss out of 41 times, 7 times he's made a loss. Okay, the rest. So we don't know exactly when those 7 years will come. But if you actually stay for a longer period of over 10 years or 12 years, that is the time you'll actually make money in the equity market. So everybody says that equity is very risky. Actually, I would tend to use the term volatile. Okay, because if the volatility is not there, then the market will not move. It will remain stagnant. So if you look at here, the general rate of return is anywhere between 10 to 12 or 14%, which is actually 7% above inflation. So equities are the best way to make money in the long term. Now, what happens if somebody doesn't have, okay, let's discuss on this. Why would somebody buy equities? One is it offers higher returns. It helps to beat inflation. It attracts a very lower rate of tax at 10%. It's very liquid because in 24 to 48 hours, you get your money in your bank account. And there are two ways of investing, active and passive way of investing. And India has a long way of going, so it's India is going to grow, and equity is definitely going to be one of the modes whereby you can create wealth. So this is the taxation part, where I was saying that the anybody who's staying in the market for less than 12 months amounts to short-term capital gain, which is at 15%. And long-term capital gains is all shares or units which are held more than 12 months. So there, up to 1 lakh, there is no capital gain tax, but thereafter your capital gains are taxed at 10%. Okay, the other investments, that is the other asset class, always attract tax at your marginal tax rates. Now, one way of doing investment in equities. So what if somebody doesn't know about stocks, or he doesn't know that if he doesn't have a broker? So then mutual funds are another way of investing in the equity markets, but in a systematic way. There is a category of investors who pool their money and they give it to the fund manager, okay, which is ideally a mutual fund which is controlled and regulated by SEBI and the Association of Mutual Funds. They invest this money, and what returns come is ideally distributed back to the investors after deducting the fund management charges. So these fund managers, they buy the securities. The securities are bought and sold. By securities, I mean stocks and even bonds in the government debt market. The returns which come after the expenses, they are returned back to the investors. So well, the way of investing in mutual funds, the logic is that whenever the markets are down, you get more units, and uh, uh, when the market is up, you get less units. Here, I have shown you the categories of mutual funds. So in debt funds, there are 15, 16 categories of debt funds. Any duration between 1 to 3 months or 6 months is ideally kept in overnight or liquid funds or short duration funds. Okay, then for 1 to 2 years, you have dynamic bond funds, and anything above 2 years to 3 years, you have long-term funds also. Then there are equity funds, which again has 8 to 10 categories, uh, which invest into various sectors like large caps companies, mid cap companies, small cap companies. So these are the equity funds which invest across various categories. Then you have what is called as balance funds also, which is another category for typically investors who are conservative or who invest primarily into bank FDs. They can always look at something which are called as hybrid funds. And then you have, of course, solution funds, which are typically aligned towards retirement or children's funds. Now coming to the part of what is your good liabilities and bad liabilities. Whenever we do financial planning, or when we ask people to invest, we tend to find out what are the good liabilities. That are you saving for your housing loan? Are you saving to do startups? Or are you saving for your children's education? By bad liabilities, it's generally whether somebody is buying an expensive car, or is he going for credit card dues, is he loaning to his friends, colleagues, or family members, sorry, relatives, or buying expensive gadgets. So so you try to analyze and understand that what is the liabilities towards which you are saving. Are you going to save it towards good liabilities, or is bad liabilities forming a part of your regular cash outflows? Now, there are some myths about investing. People generally say, whenever we talk about insurance or other asset class investments, there's always, people say that insurance is only for tax saving, or it's only for investment. And there are times where people say, I don't need insurance at all. But if you see here, the reasons is many people, when they say I don't need insurance, is they probably think that they're never going to die, or they're going to inherit a fortune from some family member. Many people say that, okay, we are going to win some lotteries. Some people say, okay, I don't like my kids because they are not loving me. And the last is, some people feel that the government is going to take care of their family. So these are some of the reasons people tend to avoid insurance. But if you ask us, why should you be buying life insurance, it's generally, uh, who else thinks about your family except you? Okay, if you like your spouse, kids, and parents, that is the time you should actually be buying uh, insurance, so that if god forbid something were to happen to you, your spouse, your kids, and your parents are taken care of. Now, many people ask us, how much should we take, or what is the thumb rule? So we tend to tell them that 10 times of your gross annual income and your future expenses and goals, like your housing liabilities or your car loan liabilities, all these should be accounted for. So the best way to take is what is called as term insurance policies, where the premium payment is low, but the risk cover is very high. And one tip which I would like to give you is, do not buy life insurance, just for tax saving purposes. Please ensure that you buy it to, take care of your family. So now here, what I'm trying to, guide you on is what is adequate life insurance cover. So say a family's expenses are 1 lakh rupees a month. So the capital required to sustain that family, God forbid, if something were to happen to the pilot or captain of the ship, and today if the interest rate is at 6%, so ideally a corpus of 2 crores would be required. And if that corpus was kept in the bank, At 6%, it would give 12 lakh rupees an annum, which is 1 lakh a month. To that, we would say that you add your liabilities, your housing, your personal loans, your vehicle loans, and from that you would need to subtract your liquid assets, which are your cash in your bank, or your PPF, or your employees provident fund. So ideally, if you deduct all that, and then what is the remainder should be your actual risk cover. But we always tell people that your liquid assets are something which you should keep, and you take a little bit of higher cover, so that you don't have to liquidate your assets which are there with your family. Alternately, if the interest rate is 8%, then you need to take a you need to take a cover of 1 crore 50 lakhs. Now, coming to the health insurance part, why is health insurance important today? If you post COVID, if you have seen, there's a lot of rising medical costs. There are uncertain hospital bills. There is the expensive the healthcare services have also become very expensive in today's times, in all cities, practically all cities, not only Bombay but even in all other cities as well. Okay, the benefit is that family health insurance comes at a lesser premium. If you take a family floater cover, it helps the family, and the premium is a little less also. You get tax benefit under section 80D of the Income Tax Act, and there are three types of medical covers which you can take. One is a mediclaim, which is for your health. Then there's critical illness, god forbid some critical illnesses falls upon you. And then there's personal accident for people who generally are out, and if they are traveling. So then personal accident helps a lot when they are on the job, out in the field. This is just a slide to tell you that what is the top 10 killer diseases, and what is how many people have died based on the respective diseases on a survey of 1 lakh people. So ideally, it is better that you take health cover at the earliest, so that these things can be taken care of in case of any untoward event. What happens when somebody is in between jobs, or if there's a medical emergency? So ideally, you should save 6 months of income, park it in your savings bank account or fixed deposits, or in what is called as liquid mutual funds, so that in case if you're in between jobs, or if somebody or suddenly you've been told to lay off, the least you can do is during that emergency, at least you can take care of your uh, exigencies like this. So just to have a recap, basic tenets are: build an emergency fund, minimum 3 to 6 months expenses in a bank FD, have life insurance cover of 10 times. Okay. Health cover ideally should be a minimum base cover of 5 lakhs with a 15 lakhs top up. Okay. The disability cover should be minimum 5 times of your gross income. We would suggest that you invest aggressively in equity mutual funds through SIP route, keeping your goals in mind, because like I said, equity is not everybody's cup of tea, and you'll have to do a lot of research out there to buy and sell the stocks. Okay, and start saving for a plan with a long-term perspective. Now here, what I'm trying to say here is that what is compulsory we do, and what is optional and important we don't do. So like everybody knows, that today apple a day keeps a doctor away, but not many people tend to do it. So when we are told to take our medication, we do it compulsively. But what is optional, and the doctor tells us that please go out for a daily walk, we tend to ignore it. On the second point, we extend our immediate present. By that I mean, what has been done by our parents and grandparents, investing in typically in bank FDs or PPF. I'm not saying that they are bad, but you must adopt the new methods of investing a little bit of your investments into equities, whereby you tend to make money, and follow the new mechanism. Okay, good financial habits are more important than financial intelligence. The idea is, even if you start with a small sum, of doing a small SIP in a mutual fund, that is going to help you in the long run, rather than trying to understand that 2 years I'll buy gold, then 2 years I'll buy silver, 2 years I'll put into commodities. There'll be a lot of noise in the market. So but what will save you is your good financial habits. So the idea is, just keep on doing your investments regularly. Don't look at the returns, because in each asset class the returns are quite volatile at times. Now, coming to the tax saving part, what I've tried to show you here is there are various instruments, which give you the rate of return against the lock-in period. So, if you are employed in a company, in a corporate, then your employee provident fund gives you roughly 8.10% per annum, but the lock-in is done until retirement. If you have your own PPF account, the returns are 7.10, but the lock-in is for the first 15 years. The money is locked in, and then after that, every 5 years, for a block period, you can keep on renewing that PPF account. Then you have your bank fixed deposits for 5 years, and your senior citizen schemes and life insurance policies. And then there's another category, what is called as equity linked saving schemes, which is mutual funds category, where the money is invested for tax saving purposes for a period of 3 years. So this is the least amount of lock-in period, and the money also grows at 12-14% in a ELSS scheme. Of course, I want to state that the returns are not guaranteed in mutual funds, but on an average, it has been observed that anywhere between 12 to 14% has come in equity linked saving schemes. Then you have unit linked policies, which is called as ULIPs, and of course, you have your housing loan payments. These other categories of asset classes which are there, just to make you aware, there is what is called as company fixed deposits. So there are some companies which are rated AAA by the credit rating agencies, and there are like HDFC, Mahindras, Bajaj, Shriram. They invest and give you, you invest the money with them, and they in turn put this money to use in corporates, and you get a little better rate than the bank FDs. The rate of interest keeps on changing every month, so ideally you need to check with the latest rates with the companies before investing. Then you have what is called as tax-free bonds, which were the last issue came out in 2014. Post that, no other tax-free bonds have come out as of now. They are however available in the secondary market on the stock exchange. So here the income is tax-free, which yearly interest which you get on these tax-free bonds. So these are the primarily the four government bodies which are issuing tax-free bonds. Then you have what is called a category of non-convertible debentures. So you must look out for secured redeemable non-convertible debentures, which actually are very safe instruments. Your interest is given by these companies on a monthly or a yearly basis, and these are some of the companies which have floated the NCDs in the last few years. So you must check with your broker or your financial advisor. If these NCDs are available, you can definitely invest these, which will give you a better rate than the bank FD rate, and there'll be a regular cash flow also. Then somebody who has invested and sold in, who has invested in property and sold their property after 5 years, 10 years, 15 years. So there is a long-term capital gain. Long-term capital gain taxed, on the property. So if somebody wants to save tax, then they can invest in this category, which is called as capital gain bonds under section 54 EC. Now these bonds again are issued by the government bodies only, which is REC, PFC, and IRFC, and the money is locked in for 5 years. 2 years back it was only 3 years, but since then the rate of interest has also fallen from 6.5% to 5%, and now the money, the lock-in period has increased to 5 years, and on maturity your capital is returned back to you, so there is no tax because it's your own money coming back. So one can look at this category also to save tax when the property is sold. You can of course ask your chartered accountant as to what is the amount of tax you need to save by investing in these bonds. Then you have what is called as annuity plans. These are typically issued by the life insurance companies, so that post retirement, if you want a regular cash flow on a monthly basis or a half yearly or yearly mode, then you can invest in these annuity plans. But let me remind you, currently annuity is taxable in India as per the tax laws, and if at all you buy an annuity plan, you must take something which is called as return of corpus to the nominee, so that post your God forbid something happens to you, the corpus is returned to the nominee. And the annuity income is, of course, when you invest, is directly credited to your bank account by the insurance companies at the time of subscription. Now this is just a standard disclaimer. Typically what I've shown you here is just to create an awareness and what are the rates of interest which have been arrived at from these asset classes over a period of time. So please do not go by hardcore rate of interest. It's basically it is just to make you aware that this is the average rate or the tenure of holding, uh, and you must always ascertain what is your personal requirement and your risk profile with your chartered accountant prior to investing in these asset classes. So Riddhi, I'm through with the presentation. We can open up for Q&A now.
Yes, definitely. Thank you so much.
My
This
pleasure.
was a
Thank
very,
you.
very informative session. I hope all the attendees that have joined this event today would agree with me when I say that this was a very informative session.
I'm very sorry for the technical glitch which happened in between. So I was
No,
just
no,
trying to.
no problem. We all can understand that something or the other keeps happening. It's not in our control. All right, so we've got some questions already in the
Sure.
Q&A.
Sure.
I encourage everyone, whatever questions you'll have, please put it in the chat box or the Q&A box. Okay, the first question here we have is, what is the best time period for SIP in mutual funds?
Okay. To answer this briefly, A is if you're coming to SIP in mutual funds, if you're investing in the equity category, you must ideally look for any period between 5 to 7 years if you actually want to make money. But there are debt funds where you can save money in lump sum or SIP mode to meet your
Okay,
short term criteria between 1 to 3 years also.
all right,
I hope I'm able to answer it, because if somebody wants more detailed answer, then it will overshoot your webinar timing, and I'll be
right.
glad to answer it on mail or something, or maybe on a one-on-one I can take it ahead.
Correct. So I think for everyone, let me just say that Nimish sir's details are on the screen in front of you. So if anybody would like to get in touch with them, definitely y'all can. And if in case later y'all realize that y'all want to get in touch, please do contact us and we can share the details. Right. So next question here that we have, just 1 second, please. Yeah,
How to
is
save for emergency funds?
yes.
Correct.
Where to save? Is savings account best for emergency fund?
Yeah. So ideally, savings account is good for emergency fund. But so that is if you are disciplined and you're going to earmark that much amount for emergency. Otherwise, we always tell people that you can put it in a liquid fund, where money can come back to your bank account within 36 to 24 to 36 hours. Okay. Or you can keep the money in your savings bank account, but just earmark that money so that you don't use it for emergencies.
Right. Next question we have here is please elaborate about NCB.
Okay, I think the person, Mr. Karan, meant, I think, NCD. NCD is non-convertible debentures. They are on the secured side of your asset classes. So basically, if instead of a corporate FD, companies come out with debentures, which has face value of roughly around 1,000 rupees at times, and on that they give you interest based on the amount which you invest.
Okay. So
So
I
so
hope,
I hope that answers this question.
yes. If you have any further questions related to this current, please put them in the chat box. Which mutual fund to choose? This is another question
Okay.
from an anonymous attendee.
Okay, which mutual fund? I would say there are 44 fund houses. Each fund house has almost 100, 120 schemes.
Wow.
So, so typically to filter out those parameters, we need to understand what are your exact requirements. And like I said at the beginning, we work on distribution model. I'm not a registered investment advisor. So the difference is, registered investment advisors, they give you the fund names and they'll charge you fees. We work on distribution model, but we have the field open. We will just make you aware about the categories based on your requirement, whether you need to go for a large cap or a small cap or a mid cap. We do not insist that you go for A fund or B fund, because we cannot be biased as per the SEBI regulations. So I'll make it amply clear that I'm not after commissions or anything of that sort. As long as you make the money, we will definitely make money. But the idea is the fund should meet your criteria, which is of prime importance.
Correct. So I think you can probably reach out to Mr. Nimish personally for that recommendation. Next we have here is first of all somebody saying very nice session. So thank
Thank you.
you. And my brother has an account on FinCash. Is FinCash recommendable?
To be very honest, I'm hearing FinCash for the first time, so I would like to see the screen or what does it invest into. Then probably I can try and explain to them. So for me also every day is this is something new for me to learn. So I'll also have to find out what is FinCash.
All right, no
Yeah.
problem. Moving on. The next question we have here is I have a wedding planned. What is the best possible way to invest in gold?
Okay, Mr. Karan, uh, all the best for your wedding. I don't know what is the time frame you're planning, but the best way to plan is, like I said, either you buy physical gold if you're going to make jewelry out of it, or you can invest in these the gold bonds, which I've said is one way. Then there are mutual fund schemes also which invest into gold. Only thing is that in the gold bonds you invest as per the rate which is prescribed by the government. So per gram the rate is quoted, which is say 5,000 or 4,500 or 4,800. But if your cash outflow permits only 2,000 or 3,000 rupees a month towards gold, then probably you can look at mutual funds also to invest in that asset class. So in mutual funds there is no lock-in period as such, but yeah, within 3 years if you exit from a gold mutual fund, whatever the tax applicability is there will be applicable to you.
So I think he wants to invest for 1 year, is what he's saying.
Yeah, so probably I think you can take a gold mutual fund, or you can take physical gold if you're, like I said, if you're going to make jewelry out of it.
Okay, I hope Karan we've answered that question.
Yeah, because
Next,
because the price is too volatile, for gold also. It's based on the global situation which is happening. Gold is a commodity where the prices will keep on jumping up and down.
right. Next we have here is which debt fund would you recommend?
Okay. Like I said again, so there are many debt funds, and the categories like I showed you in debt funds are almost 15. So what is your time frame, for saving within 1 to 3 years? And there are so many funds are there. So we would have to sit across and make you understand those criteria and then recommend the debt funds. As per SEBI rules, I'm not at liberty to give out names of funds randomly. So you can do Google search, but after we understand, then probably we can tell you which categories, which fund houses are there, and from that you can choose that category.
Okay, thank you. So I hope that is also answered. Next we have here is how much should we save in emergency fund?
Ideally, you should start saving for 3 to 6 months of your household expenses. And as soon as you get a buffer of 6 months, I think you should extend to 9 months or almost a year. So for salaried people, at least 3 to 6 months. But even for somebody who's doing business, at least 12 months of your expenses, if you keep aside your staff salaries and your other home expenses, that will take care of your business, and that pressure does not translate into your personal life. Because if cash flow is not there, you typically get affected, and then it disturbs your whole working culture.
Right. So thank you for that answer. Next we have here is equity liquid money?
No, if you actually ask me, equity is, if you're investing in shares, it's not liquid money. Yeah, it comes within 24 to 48 hours, but equity is not liquid. It's ideally meant for wealth creation, which should be above 5 to 7 years. Somebody who does day trading, he can treat it as liquid money, but that is his own business, and he needs to be full time a day trader or a dealer to understand everything. Then he can treat it as liquid money. But ideally, if you ask me, equity is not liquid money.
So somebody has mentioned what can be considered as liquid money.
Like I said, where today you put money in your savings account, okay, that the bank puts that money into repo rate market, which is government treasury bonds of 91 days or 180 days or 360 days. That is called as liquid money. So liquid money, even in mutual funds, are debt mutual funds, which are invested in the treasury bonds. So where there is not much movement in the interest rates. So the money is also available to you very easily. So liquid money is typically repo rate investments in the treasury bonds, and you and me as laymen, cannot buy it as such. But if we give money to the fund manager, then they are in a position to buy those treasury bonds, because there's a separate license to invest the money. Now the Reserve Bank is coming out where you can buy treasury bonds even on the from the RBI website, but it's still at a very nascent stage. They've started it 6 months back.
All right. Thank you again. Next question we've got here is, what mutual fund is better for long term and short term?
Okay, so this is also a very what do you say? It's a little technical question. So if you have somebody who's I can put it this way, that somebody who's a conservative investor, he can look at long term, meaning large cap mutual funds, okay, and short term mutual funds. Uh, there's nothing like short term would be the debt category, and long term would be the equity funds. But coming to the conservative and aggressive investors, you have other classes which is called as small cap funds. So aggressive investors can look at small cap funds, which would be held for 7 to 8 or 10 years, which will give you good returns.
Okay.
Yeah. So again, I'm not at liberty to tell which mutual fund, but I can only stress on the categories.
Right. Couple of more questions here. Is buying stocks online safe, like on Zerodha or Grow or Upstock?
Uh, yeah, if you are comfortable and you know the systems, buying on these portals are good. But ideally, if you ask me, uh, some of these portals have just come in now, so you must try to understand what is your demat account. You must keep your user ID logins to yourself. Yeah, if you're going to buy sell stocks, I would say every week or every 15 days, please look at your portfolio, ensure that your holdings are there. Okay, so these online portals have come up, but even your banks are having demat accounts and online trading portals. So the difference between that is that the people are fed up at times of bank RMs giving them advices, whereas these online portals at times they tend to give you stock tips, and people feel that okay, if they are giving tips, maybe there must be something, but there's a whole other facet to it, that who has done the research. Are you willing to take that risk? If the After buying, if the market goes down, are you willing to hold on to that? So that's the only difference. It is safe. These guys have come up because they've been given licenses by the regulatory bodies, but you must do your due diligence. Please ensure you check your portfolio at every periodic intervals.
Okay.
So I hope I
Thank you so
answered
much.
that. Yeah,
Yeah, thank you for that tip also at the end.
yeah,
We should definitely monitor what we're investing in, if it's an online portal
yes,
or
correct,
even offline, I would say.
correct.
Right. A few more questions here. Can I redeem my 10 years old equities considering present situation of expected war and inflation?
So Sanjay, I would say that this is the time where if you observe, your capital would have increased to quite a large extent when the market is up, but you must not be affected by these global factors. What we tend to do is, when we take you one-on-one meetings, we ask you to invest in equities and mutual funds, and we align your mutual fund schemes to that goal. So over these years, last 8-10 years also, I we have paucity of time, otherwise I would have shown you slides, that market is going to be volatile. But to put it short, only if you need money which is for immediate use, then you need to redeem a part of your portfolio if you require the money. Otherwise, these global factors will keep on coming and going, and market will be volatile. But in the long run, India is good. If you ask me, and people are going to come to India to invest based on the China situation. And I'm not an economist, but I'm just telling you from what I read. So if you don't require the money, don't redeem it, but definitely do not panic, because the time spent in the market is more important than timing the market. And many a times I've seen people who have exited like this due to COVID and other things, they have not been able to enter back into the market.
All
So
right.
I hope, yeah.
Sorry, last two questions I think we have in the chat box as well. What is the best advice for youngsters for investment?
Youngsters for investment, like I said, one thing is you start saving for your 3 to 6 months or 9 months expenses, keep emergency fund, because if you're going to jump jobs or whatever you require for emergency, you can build a emergency fund at the side. Secondly is to plan towards your either your marriage or your startups or maybe your retirement, and you can do via mutual funds if you're not doing direct stock investing. I don't do direct stock investing. I generally we tend to advise on via mutual fund route. So
Okay.
if you invest, probably through the mutual fund route now, you will tend to get a huge corpus, at least of 2 3 5 crores if you start now. By the time you retire, so if you want plan a early retirement instead of 60, you want to retire at 55, please do start saving now.
That's a good tip again.
Yeah.
All right. I think last question we have here is, what is Residex? Can you please explain?
Yeah, Residex is basically a residential index. So like how you have the Bombay Stock Exchange, no? NHB is the National Housing Board, which has come out with a Residex. So the residential index, there was a benchmark of 100 in the year 2007. So after that, the prices have started rising. Okay, so then the base year was changed from 2007 to 2017-18 now. So if you go on the NHB website, you will typically come to know that from 100, the price has moved to 120 or 130 or 140, or at times in some cities, it has been stagnant at 100, 98, 102. So that gives you basically a benchmark against what your property is valued to the prices of the property in your area or your neighborhood or your city. So that is what is called as Residex, but not many people are aware that from 2007 this has been launched. So I hope that answers the question.
Yes, I think we're done with the questions here. If anybody has any further questions, please put them in the box now, or you can always email us or email or contact Mr. Nimish. Uh, and thank you so much for this wonderful session.
My
I think
pleasure.
it was
Thanks.
really important, and it is like much appreciated. Many people have written in the chat box as well. It's very important that we understand the importance of financial freedom, and for that,
Right.
I think we definitely need to start early and realize the importance of it. So thank you so much again for coming and doing this session for us.
My pleasure.
And thank you everyone who came and gave us this time to attend this webinar by Inform My Team. Thank you so much.
Thanks so much. Thank you. Bye bye.
I would just like to say, all of the attendees, in case you have any questions or anything, please do reach out to us. And also, this recording would be available on YouTube, and we will also be sharing it via email to all of you. And also, a feedback form would be shared with you soon after the event. So please do share your feedback with us. Thanks a lot.